Hello everybody, this is Alex Merced from alexmerced.com, and what I wanted to discuss today was the bond market. A lot of people, you hear a lot of talk about different countries' debts and people buying and selling debt, and this may be a little odd to most people if you don't understand the bond market. So I thought I'd create a video explaining kind of how the bond market works, how bonds generally work. So when people say bond prices are going up, yields are going up, what does that mean? Okay, so first let's talk about the whole price yield relationship. That's sort of, if you don't understand sort of the characteristic of a bond, then everything else is kind of just won't make sense. So, for example, let's say I want to borrow $100 million. Not one person is going to lend me $100 million. So what they do is they securitize it. So they create it into these sort of legal, contractual obligations that are separated into sort of purchasable pieces. Bonds usually are denominated in denominations of $1,000. So each bond represents a $1,000 loan that I'm making to a company, a municipality, a government, whoever. Okay? So I'll buy this $1,000 bond, and it'll have what's known as a coupon or nominal rate. So this is the original rate of interest. This is the rate of interest that the issuer, the person who's borrowing the money, promises to pay the bondholder, whoever holds the piece of paper, this bond, every year, based on the original loan of $1,000. So, for example, let's say I buy ABC company sells me a 10% bond. Okay, so that means they're going to give me. I'm paying $1,000 for a bond, and ABC company promised me to pay me, the person who's holding the bond, 10% of $1,000 every year. Okay. So that means I'm getting $100 every year. So whoever holds this bond, so if I sell it to somebody else, or if I give it to somebody else, whoever, that person will now get the $100 every year. As a side note, the $100, they don't give it to me in one $100 check. They generally pay me in two $50 checks every 6 months. Okay? So now I have this 10% $1,000 bond. Now let's say 3 years later, ABC company wants to issue and borrow more money. But now interest rates have changed in the economy, and they're now 13%. So now ABC company is selling new bonds for $1,000, but at 13% interest. Now me, I would love to buy that 13% interest bond, but the thing is that my money is tied up in the 10% interest bond. So what I have to do is sell my 10% interest bond first. The problem is, no one's going to pay me $1,000 that I originally paid, because if they had $1,000, they'll just purchase the 13% bond. So since interest rates have gone up, my 10% bond is less valuable than those 13% bonds. So what's going to happen is I'm going to have to discount my bond. So instead of selling my bond for $1,000 like I paid for it, I have to sell it for $800, for example. Okay, or whatever rate would give you a same return as those 13% bonds. So I would actually I'd have to price my bond lower than $1,000 till I get to the point where whoever buys the bond will have a return of 13%, even though the bond that I'm selling still only pays 10% of $1,000 every year. But since you're paying less, the return changes. So again, the idea here is, since interest rates went up on the new bonds, my older existing bond is now has to drop in price. So interest rates go up, old bonds go down in price. Okay? And vice versa. If interest rates had gone down, then I can since people can't find, so for example, if it went down to 8%, people can only buy new bonds at 8% for $1,000, so suddenly my 10% bonds will be more valuable, so I'll be able to charge a premium for it. So this is why when yields go down, prices go up, and when yields go up, prices go down. Okay? Now these yields tend to get set by the market. So for example, what happens is that bond traders will trade bonds over the counter. Okay, so it's not like a stock exchange, like stocks, where you can just buy and sell stuff. Generally with bonds, you actually have bond traders, and they're calling each other, saying, okay, this dealer's got this bond at this price, this dealer's got this bond at this price, trying to find the dealer with the best price. So it's a little bit more work to find a bond. So this is why you're generally paying higher fees, they're more expensive. It's more of an institutional market. It's not mom and pa buying your typical bond. Okay, it's more sort of large money managers and large institutional investors. Okay, pension funds, mutual funds, etc. Now what happens is this. How does this affect the company or the issuer? Now if the traders trading the bond push up and down the price. So if they push up the price, that means the yields of the bond have to drop. Okay, now why would the price go up? Because maybe people have more faith in ABC company for whatever reason. So it's a safe place to put your money. So people who are looking for safety will be willing to pay more, even though they're getting a lower yield on ABC company's bonds. Vice versa, if people are starting to lose faith in ABC company, they'll start bidding the price down, and the price will drop, and the yield will go up. But what happens is, if ABC company wants to issue new bonds later on, it'll be affected by whatever the yields of its old bonds are. So basically, if bond traders have traded the yields up to, so let's say it was a 10% bond, and the bond traders have traded the yields up to 15%, meaning the price is way down. They traded up the yields to a higher yield. That means when ABC company has to issue new bonds, they're gonna have to sell them at 15%, because if they don't match their old bonds, then people won't buy the new ones. They'll just buy the old ones because they can get a better price. Okay, so vice versa, if they bid down the yields really low, meaning they bid up the price real high, then it makes it real cheaper for the issuer to borrow more money. Okay, so this is why it's such an issue when bond prices change. Okay, because it means that the people who are issuing these bonds are not going to be able to borrow so much more money in the future. Okay, so when yields go up, initially it doesn't affect anything. It just means the bond prices are more or less. It affects the investors. So if yields go up, meaning prices go down, sucks for the people who owns the bonds. They've just lost a lot of money when they go sell their bonds. Vice versa, if rates go down, it's good for the current bondholders because they just made a lot of money. But from an issuer's perspective, the more I see rates go up, the less ability I'm going to have to borrow money cheap in the future, so thus I'm going to be more careful. So I'm not going to be rushing to take large risks, any large expenditures, because if I make a mistake and I end up needing money really quick, I'm going to have to sell new bonds at a higher interest rate. Okay, so right now people have been talking about treasury rates going up. If treasury rates go up, the U.S. government will have to clamp down because the cost to continue borrowing money would be too high. Okay, so this is why the Federal Reserve fights to keep interest rates down. The problem is that it ends up being kind of enabling. If it makes it too easy to borrow money, then the government just borrows more money. And if there's an institution that's going to do it, it's going to be the federal government, because the people who make the decisions aren't liable for them at all. So if you're a politician, you work there for 2 years, the deficit gets bigger under your watch, no one's going to come to you and sue you later on. Like they could sue a CEO or take action against a CEO who financially mismanages a company. So since the governance mechanisms are a bit different. Okay, so this is why interest rates are important, and this is why when they say like the interest rates on a couple key terms to know, when people say treasuries, that's debt of the federal government. When they say municipal debt is the debt of states, towns, localities. If people say sovereign debt, that's the debt of other countries' governments. So not the debt of their companies, but the debt of their governments. Okay? So when they say there's a sovereign debt crisis, that means foreign governments going bankrupt. When they say there's a municipal debt crisis, that means municipal, state, and local governments going bankrupt. They said there was a treasury bubble, that would mean the federal government went bankrupt. And if you've seen my previous videos, I've been predicting a treasury bubble for a while. And I still do. So hopefully this was helpful in understanding the bond market, so that way you can pay attention to what's going on in the economy a little bit better. If you can follow the bond market, because currently the global economy runs on debt. It doesn't have to. Okay, there's two types of financing. There's debt financing, meaning you borrow money, and then there's equity financing, meaning you sell ownership. Okay, me and you, everybody is a finance expert. You just don't know it. Have you ever gone to a friend and said, let's go halves on a pizza? You pay half, I pay half, I get half the pizza? That's equity financing. You're selling him ownership in the pizza for putting up the money to buy half the pizza. So basically, he paid for half the ownership of the pizza. That's equity financing. That's like buying stocks. Vice versa, bonds is debt financing. This is like, hey, can I borrow the money to buy myself a pizza? You own the pizza, but now you owe your friend money. That's debt financing. Okay? So right now, most of the financing around the world works that second method, debt financing. But there's no reason why when you buy a house, you can't do equity financing. Why you can't go halves on the house with the bank. Why you can't go halves on a business with a bank. We do that now through a lot of venture capitalism, etc. So the world can move towards more equity financing and less debt financing, but right now it's not structured to do so because mainly bank intermediaries were more necessary, and they make more money on debt financing than equity financing, and it has a lot to play into it. So we'll see how the future of financing in the world evolves. There'll be some changes. I have an idea of what to expect, but I'm not going to get into it into this video. So thank you very much. My name's Alex Merced from alexmerced.com. Check out the website. Plenty of good videos. I've organized them into easy to access playlists, so that way you can find videos on the topic that you're interested in. So go to alexmerced.com.